Investing in stock exchanges is not always an easy thing to do. It takes experience, smarts, and a bit of luck. What I've learned about trading and investing for beginners is not to invest in anything unless you're 100% sure that you can handle the financial losses. It's better not to risk as much as trying something and losing a lot of money. With this in mind, it's vital to remember that the stock market is always changing and things can go down faster than they do up. Hey guys, welcome back to the channel. Thanks for joining us today. Today we'll be speaking about investing in stocks for beginners. Please watch the entire video to figure out all the details. And guys, don't forget to like, share, subscribe, and click the bell notification. Alright then, let's get started. The goal of investing your money is to grow it, and by investing into stocks, you'll see that stocks have the highest potential for making money in the shortest period of time. Putting funds into an online investment account, which can then be used to invest in shares of stock or stock mutual funds, is one of the best ways for beginners to start investing in the stock market. You can start investing for the cost of a single share with many brokerage accounts. Some brokers also offer paper trading, which allows you to practice buying and selling on the stock market without risking any real money. Here are 5 steps to figure out how to invest in stock for beginners. Number 1. Choose an investing account. In general, you'll need a brokerage account to invest in stocks. It usually entails a brokerage account for the more hands-on types. Starting an account with the Roboadvisor is a good idea for those who need a little extra help. Both processes are deconstructed in the following sections. One thing to remember, you can open an account with both brokers and robo-advisors with very little money. Buying stocks, funds, and other investments through an online brokerage account is likely the quickest and most cost-effective way to do so. If you're saving adequately for retirement in an employer 401k or other plans, you can start a taxable brokerage account with a broker. Buying stocks, funds, and other investments with an online brokerage account are likely to be the quickest and most cost-effective option. You can open an individual retirement account, aka an IRA, or a taxable brokerage account with a broker if you're already contributing enough to a 401k or other retirement plans through your employer. The passive option of opening a Robo-Advisor account. A Robo-Advisor provides the advantages of stock investing without requiring the owner to do the legwork involved in selecting individual investments. Robo-advisory services cover all aspects of investment management. These firms will inquire about your investment objectives during the onboarding process and then construct a portfolio to meet those objectives. Although the management fees may appear to be high, they're typically a fraction of what a human investment manager would charge. The majority of robo-advisors take 0.25% of your account balance as a fee. Yes, you can get an IRA through a robo-advisor if you want to. As an added bonus, if you open an account with a robo-advisor, you won't need to read any further in this article. The rest is for those who prefer to do things themselves. Number 2. Learn the difference between investing in stocks and funds. Going the do-it-yourself route? Don't be concerned. Investing in stocks doesn't have to be complicated. For the most part, stock market investing necessitates choosing between 2 types of investments: exchange-traded funds or mutual funds that invest in stocks. In a single transaction, mutual funds allow you to buy small pieces of many different stocks. Index funds and ETFs are mutual funds that track an index. For example, an S&P 500 fund buys the stock of the companies that make up the index. You own small pieces of each of those companies when you invest in a fund. To create a diversified portfolio, you can combine several funds. Stock mutual funds are also referred to as equity mutual funds. Stocks that are held individually. If you're interested in a definite company, you can buy a single share or a few shares to get your feet damp in the stock market. It's possible to create a diversified portfolio out of many individual stocks, but it requires a significant amount of time and effort. If you select this path, keep in mind that individual stocks will experience ups and downs. If you've done your research and decided to invest in a company, consider why you chose it in the first place if the jitters start to creep in on a bad day. Stock mutual funds' upside is inherently diversified, lowering your risk. A portfolio consisting principally of mutual funds is the clear choice for most investors, particularly those investing their retirement savings. On the other hand, mutual funds are unlikely to rise as quickly as some individual stocks. Individual stocks have the advantage of a wise pick paying off handsomely, but the chances of any individual stock making you wealthy are incredibly slim. Number 3. Set a budget for the stock market investment. In this stage of the process, new investors frequently have two questions. How many funds do I need to begin stock investing? The amount of money essential to obtaining a single stock is determined by the price of the shares. Shares could be acquired for as little as a few dollars or as much as a few $1,000s. If you want mutual funds but don't have a lot of money, an exchange-traded fund (ETF) might be the way to go. ETFs trade like stocks, so you can buy them for a share price, in some cases less than $100. Mutual funds often have $1,000 or more minimums, but ETFs trade like stocks, so you can buy them for a share price, in some instances less than $100. I'm not sure how much money I should put into stocks. If you're investing through funds, have we mentioned that most financial advisors prefer this method? If you have a long time horizon, you can allocate a significant portion of your portfolio to stock funds. A 30-year-old investing for retirement might invest in stock funds for 80% of their portfolio and bond funds for the remaining 20%. Individual stocks, on the other hand, are a different story. As a general rule, limit these to a small portion of your overall investment portfolio. Number 4. Focus on investing for the long term. Investments in the stock market have conclusively been demonstrated to be one of the most effective ways to build long-term wealth. Over the decades, the average stock market return is around 10% per year. However, keep in mind that this is just an average for the entire market. Some years would be better than others, and individual stocks will have different returns. The stock market is a good investment for long-term investors, regardless of what happens day to day or year to year. It's the long-term average that they're looking for. Stock investing is prevalent with complex strategies and approaches, but some of the most successful investors have stuck to stock market fundamentals. That usually means putting most of your money into mutual funds. Warren Buffett famously said that a low-cost S&P 500 index fund is the best investment most Americans can make, and picking individual stocks only if you believe in the company's long-term growth potential. After you start investing in stocks or mutual funds, the best thing you can do is to ignore them. It's best to avoid the ability to check how your stocks are doing several times a day, every day, unless you're trying to beat the odds and succeed at day trading. Number 5. Manage your stock portfolio. While obsessing over daily fluctuations isn't good for your portfolio or your health, and you would need to check in on your stocks, other investments from time to time. If you use these steps above to buy mutual funds and individual stocks over time, you must appraise your portfolio at least once a year to ensure that it's still on track to meet your investment objectives. Here are a few things to reflect on. If you're nearing retirement, you might want to shift some of your stock investments to safer fixed income investments. Consider buying stocks or funds in a different sector to diversify your portfolio if it's too heavily weighed in on one sector or industry. Finally, geographic diversification should be considered. According to Vanguard, international stocks should account for up to 40% of your portfolio. To get this exposure, you can buy international stock mutual funds. Okay, so what do you think about investing in stocks as a beginner? Do let us know in the comment section below. Well, that's all we have for today. If you enjoyed today's video, don't forget to like, share, and subscribe.